Today, a spotlight on Rockingham. Hello again, it's Martin North from Digital Finance Analytics. Welcome to our latest post covering finance and property news with a distinctively Australian flavour. Today I'm going to walk you through my recent analysis of Rockingham in Western Australia. Quite convenient really, because this is of course the weekend that WA is running an election. So I thought I would take a look at property in this part of the world, not least because of course all of the discussion is property prices are booming. Well, let's just get some context on that, shall we? And I should just add, as I always do when I make these shows, that my analysis here is based on currently available information, and it may change. I'm not providing financial advice, and my discussion should not be taken as such. We're just looking at the data from our surveys and other sources and our economic modelling, and the information is just for your own use, and it will change, so just be aware of that, please. And just as a quick recap, we're using our core market model for this analysis. We pull information in from our surveys, that's a rolling set of surveys that come in weekly, and also other sources to put into our core market model, and that core market model then drives our analysis, our industry reports, the blog, and everything else that we do. I'd also make the point that the information is quite current because we get information each Tuesday. And what this allows us to do is to take our mortgage stress data, the price trajectory and history data, the buying and selling intentions, the migration statistics, and other economic data, including CPI, wages and employment information, run it through our core market model and through our various scenarios, and that allows us to form some views as to what may happen with regard to property prices at a postcode level, at a region, a state, and an all Australia level. So I'm going to be looking at Rockingham 6168. And so we start in Perth, we go south, it's about 46 kilometres or 41 minutes if you take the main road south. And then you head off towards the coast and you end up at Rockingham here. In the immediate area, you've got places like Shoalwater, Safety Bay, and a few other places too. So there's quite a lot of coastal development up and down this area. Now here is a map of the more detailed area, and you can see there that there's a considerable amount of coastline as well as some development away from the coast, shopping centres and other green spaces. It's defined as a city and a primary centre in Western Australia, southwest of the Perth city centre and south of Fremantle. It has a beachside location at Mangles Bay, the southern extremity of Cockburn Sound. To its north stretches the maritime and resource industry installation of Kwinana and Henderson. And here are a few shots in and around Rockingham. You can see there that there's quite a lot of pleasant green spaces. This is quite close to the beach. That's actually looking out over the beach. You can see the industrial work just around the corner there. There's also a mixture of old and new development. This is actually, again, pretty much on the Esplanade, and we're seeing quite a lot of knockdowns and rebuilds in the area. There's quite a lot of ocean access, and of course moorings are quite attractive too. There is, of course, the typical centre, from everything from Kmart and Coles and JB Hi-Fi. A lot of cars. Just another view of the same area. And away from that, in the residential areas, it's more spread out. Quite a lot of low-rise building. And a lot of the recent development is on really small lots. In fact, some of them are well under 300 squares, which means that things are getting quite crammed together, particularly subdivisions and new developments in the area. That said, some of the connecting roads are quite generous, but as you drive around you see more examples of accommodation very close together, and we also have some retirement villages in the immediate area as well. So I'm going to look at both houses and units in the area. And I'm going to start with looking at those for sale. And in fact, 102 properties were for sale in Rockingham when I looked. And here is a distribution of properties for sale, quite a few running down the main Esplanade strip, and of course quite a few also away from the ocean. And we'll just look at a few examples. It's worth noting that quite often we've got expressions of interest rather than a price quoted. And houses here, well, they vary in price, but there's one there, offers from $419,000. There's a house on the Esplanade for $1.3 million. And then we've got express sale, an apartment for $280,000. And looking at some of the other properties around, particularly some of the houses, now there are quite a few villas for sale. And in some cases, these are older properties that were built like that. But in other cases, we see villas effectively built on one larger plot, subdivided, and then resold. There's a lot of that going on in the area. Another one of $529,000, offers from $749,000. In some cases we see offers from, and it's interesting of course because that basically leaves the door open for price negotiation, although the information on price is frankly quite hard to get hold of. And there are also some land parcels for sale, not least areas close to the beach. And a lot of those land parcels are being sold with the prospect of subdivision. So if you're thinking of buying a property in this area, chances are you could be competing with a development builder. In terms of what's sold, 52 properties sold in the last 8 weeks according to the latest analysis. Here's a map showing the distribution. And interestingly, relative to the distribution of those for sale, more away from the Esplanade are actually changing hands. And here is some information on recently sold property. It's worth noting again, the last asking price is not necessarily the price that was agreed. A house for $500,000, an apartment for $215,000, a house for $450,000, another house for $400,000. I always find it interesting when they show an inside view rather than outside view for a house. Another example of an inside view only. Last asking price of $650,000. And here we have a $1.2 million property in the perhaps more prestigious area of Rockingham. So now let's look at the median price trends from 2013 onwards. And in 2013, the average unit price was around $285,000. Went up by 10.5% in 2014 to $315,000. It fell in 2015 back to $295,000. It went up slightly by 1.7% in 2016 to $300,000. It fell 13.3% in 2017 to $260,000. It fell again in 2018, down 1.9% to $255,000, and fell 15.7% in 2019 to $215,000, and then a recovery of 11.2% this last year, back to $239,000. So if you compare the price today at $239,000 with $285,000 in 2013, you've lost money. And in fact, the average gain over that period was down 1.4% each year, or after inflation, down 3%. So whilst there might be a little bit of a bounce in price now, many people will still be significantly underwater. And in fact, one of the significant things to understand in this part of the world is there are many people still living in a world of negative equity. Let's look at houses in the same area, and again we're looking at the median price. So in 2013, the median price was $435,000. It went up by 3.4% in 2014 to $450,000. It went up 2.2% in 2015 to $460,000. It dropped 13% in 2016 to $400,000. It dropped another 5% in 2017 to $380,000. It dropped another 2.6% to 370,000 in 2018, and it fell again another 2.7% in 2019 to $360,000. There was a rise in 2020, up 11.1%, giving a price of $400,000. So once again, the price currently is lower than it was in 2013. The average gain over that period is minus 0.4% per annum, or after inflation, 2%. And it also shows us that the relative value of houses versus units is a little better. But both houses and units are less expensive than they were back in 2013. Now, in terms of the overall information set, there are around 260 listings in total, with 70 added in the past month. In May 2019, listings were higher at 370, around 65% are houses, the rest are units. The gross yields for investment houses is around 5%. It's actually up slightly from last year when it was 4.9%. The net yield, that's after the mortgage costs and other servicing costs, is around 3.75% and is rising. And relative to other parts of the country, particularly Sydney and Melbourne, that's actually pretty good. Units have a gross yield of around 5.6%. That's a rise from 5.2% last year. The net yield's around 3.85% and is rising. The rents for houses are rising, up 3% in the last quarter, with a typical rent of around $370 per week. The rents for units are also rising, up 5% over the quarter, with a typical rent of $320 per week. The vacancy rates are currently around 0.5%, compared with 3.5% in mid-May 2019. There are around 20 vacancies at the moment, compared with 121 back in 2019. And asking prices on average are rising, with a typical price for a house of around $395,000, up 15% over 3 months. But units are falling, down 6%, with an average price of $295,000. And the average settlement for units is about 6% lower than asking, but for houses, they're tending to settle at or slightly above asking at the moment. And the intention to sell is steady in the area, although the intention to sell is rising slightly among units. Now we can look at the stress data for this particular postcode. There are around 11,700 households, 3,800 borrowing, 5,700 renting, 4,400 properties for rent, and about 4,400 property investors. And the percentage in financial stress of households in this postcode is 44%, so that's a medium measure. It's pretty high relative to some other parts of Perth. Looking at mortgage stress, in cash flow terms, around 26% of households are struggling with cash flow on their mortgage. That's just under 1,000 households. Risk of defaults at 4% or 135 in the next year. Rental stress is somewhat higher at 48%, so that's nearly half of those renting are struggling to make those rental payments, and that includes issues to do with tourism and other industries under pressure post-COVID. There are around 2,750 households in rental stress. And turning to property investors, 34% of property investors are stressed. In other words, they're finding that they can't get sufficient rent streams to cover the costs of the investment property. They're trying to sell the property, or they're trying to relet it. And of that, 1,394 are stressed, but 97 are severely stressed. Those severely stressed are more likely to look to sell into the current rising market. So finally, we can look at our price scenarios. And as always, we look at the 3 scenarios: the best case, the longer term crunch, and the second wave. And just to be clear, the best case is assuming that the vaccine gets rolled out, the virus gets under control, the international borders open later this year, and the government continues to support the economy meantime. The longer term crunch is the situation where the virus bounces back, the vaccine rollout is less successful, and the borders remain closed longer. And the second wave is when we get another severe wave and more lockdowns. And under those three scenarios, in the first case, best case, we are looking at price rises over the next year of 10% and then a slight fall the following 2 years. Under the longer term crunch scenario, there's a small rise but then falls the next 2 years. And under the second wave scenario, there are falls in all 3 years with a cumulative fall over 3 years of about 19%. So of those three scenarios, I model off the best case projection because at the moment that holds the highest probability on my analysis. And so if we take units, in 2020, we're looking at a price on average, median price, of $239,000. A rise of 10.2% would take prices to $263,000. And then there'd be slight falls the following 2 years, which would put prices at $248,000 in 2023, which is still lower than they were in 2013, 2014, 2015, 2016, 2017, and 2018. So my takeout here is, from an investment perspective, you're not going to see that much capital growth, and if you bought a property in those intermediate years, you're likely to still be underwater. Now, with regard to houses, a similar scenario, a rise of 7.6% in the best case next year, and then slight falls the following 2 years. In the longer term crunch, a small rise and then 2 falls. And if there's a second wave of the virus and more lockdowns, a cumulative fall of 14% over 3 years is what I'm modelling. But again, the most likely scenario at the moment is the best case. So that is what I'm using for my modelling. And there we go from the median price of $400,000 in 2020, up 7.6% to $430,000, and then small falls. So we get back to $414,000 in 2023, and that puts prices back where they were in 2013, 14 and 15. So once again, there will be a number of people bought in those intermediate years who will still remain underwater. So in conclusion, I think there are a few takeaways from this analysis. Firstly, whilst there are some spikes in prices at the moment because of the change dynamic in Western Australia, away from Perth's main centre, those price movements are relatively small, and many people will still be underwater relative to the earlier purchase price that they paid. And for many people, even if they bought in 2013, they will remain underwater. The second point is that there is considerable subdivision and considerable redevelopment going on in the area. And in fact, if you are buying a house on a plot, reasonably sized plot, you are likely to be competing with builders who will want to buy to subdivide and create villas and multiple occupancy solutions on particular sites. And that, of course, lifts the values, but it means that you're basically competing on a different basis. And the third point I'd make is that the concentration of development, particularly on smaller lots, has really ramped up due to changes in the planning laws. And there are many small plots now under 300 squares. Compared that with a decade or two ago, that would just be very small. So there's a lot of relatively high density development in the area, and I would expect to see more of that ahead. So the bottom line is this: if you're contemplating buying in this particular location, go careful, make sure that you get all of the available data, and don't rely on the information from the property portals, because those property portals are only giving you half the story. It's really important to do the legwork and really understand what fair value is. And don't be spooked by real estate agents spieling that property is booming and you must buy now because you're going to miss out. The chances are there's plenty of property. There will still be plenty of property in the next 2 years or so. And indeed, the overall outlook in terms of capital growth is relatively benign in any case. So take your time, make sure you do your analysis, and then you can make the right buying decision. And I will just add before I close that this is the sort of analysis that I do on a one-on-one basis through my one-to-one service. And if you are interested in having a detailed conversation about a particular suburb with similar sorts of information available, just contact me and we'll see what we can do to help. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.